I want you to think about the last time you sat across from your financial advisor. Think about the office, the framed certificates on the wall, the professional handshake, the confident voice explaining where your money is and what it is doing and why everything is going to be fine. Think about how that meeting made you feel. Reassured, protected, like someone with real expertise was watching over the retirement you spent 30 years building. Now I want you to ask yourself one question that most Americans never think to ask in that moment. Is this person legally required to act in my best interest? Not morally required, not professionally expected, legally required. Because the answer to that question, depending on who is sitting across from you, is either yes or no. And the difference between those two answers is the difference between an advisor whose entire business model is aligned with growing your wealth and an advisor whose entire business model is aligned with growing their own income from your account, regardless of whether your account grows at all. This is Retire Right America, and today I am going to show you 5 specific ways that the wrong type of financial advisor is quietly draining your retirement right now in 2026. How to identify whether your advisor falls into this category and exactly what to do about it before another year of your retirement savings disappears into a system that was never designed to serve you. Let me introduce you to a woman named Sandra. Sandra is 63 years old. She lives in a suburb of Dallas, Texas. She spent 27 years as a human resources director for a mid-sized manufacturing company. She retired early at 61 with what she considered a very solid financial foundation. Her traditional IRA held approximately $480,000. She had a joint brokerage account with her husband, Carl, worth approximately $160,000. She had Social Security waiting for her when she chose to claim it, and she had a financial advisor named Rick who had been managing her accounts for 11 years. Sandra trusted Rick completely. Rick had been recommended by a colleague. Rick had a CFP designation on his business card. Rick had an office in a nice building and drove a nice car, and always seemed to know exactly what was happening in the market. Over the 11 years that Rick managed Sandra's accounts, Sandra paid Rick approximately $112,000 in advisory fees, fund expense ratios, and transaction costs. Sandra did not know this, not because she was naive, because Rick never showed her a single document that clearly stated the total annual cost of his services in dollar terms. Sandra knew there were fees. She did not know what they added up to over 11 years. She did not know that the funds Rick placed her in had expense ratios averaging 1.2% per year on top of his advisory fee of 1% per year, creating a total annual fee load of approximately 2.2% on her account. She did not know that the funds Rick recommended were from a provider with whom his firm had a revenue-sharing arrangement that paid the firm additional compensation when clients held those specific funds. She did not know that Rick was not a fiduciary, meaning he was legally required only to recommend products that were suitable for her general situation, not products that were in her best interest specifically. And she did not know that an identical investment portfolio managed by a fee-only fiduciary advisor using low-cost index funds would have cost her approximately 0.3% per year in total fees, rather than 2.2%, saving her approximately $7,500 per year on a $480,000 account. Over 11 years, that fee difference, compounded at a modest 5% annual return on the fee dollars that were extracted rather than invested, represents approximately $130,000 of retirement wealth that Sandra does not have today because of the 5 ways Rick's business model worked against her interests rather than for them. The first way financial advisors quietly drain retirement accounts is through the fee opacity that Sandra experienced. The financial services industry has a long history of structuring its compensation in ways that are technically disclosed but practically invisible. The advisory fee might be disclosed as 1% annually of assets under management. The fund expense ratios are disclosed in fund prospectuses that nobody reads. The revenue sharing arrangements between the advisory firm and the fund companies are disclosed in the firm's Form ADV Part 2, a document that most clients have never seen and that the advisor is not required to review with you at every meeting. The 12b-1 fees that certain mutual funds charge and that flow back to the advisor's firm as distribution compensation are buried in the fund's expense ratio without being separately itemized. When you add all of these layers together, the total annual cost of working with a non-fiduciary, commission-based, or revenue-sharing advisor can easily reach 2 to 3% of assets under management annually. The mathematical consequence of a 2% annual fee versus a 0.3% annual fee on a $500,000 retirement account compounded over 20 years at a 7% gross return is the difference between approximately $1,680,000 and approximately $1,230,000 in account value. The fee difference costs you approximately $450,000 over 20 years, not through bad advice, not through market underperformance, simply through the compounding mathematics of an annual fee that is 2% higher than the alternative. The second way advisors drain retirement accounts is through what the industry calls churning, which in its most obvious form is illegal, but in its more subtle form is perfectly legal and extremely common. Churning in the technical illegal sense means executing unnecessary transactions in a client's account to generate commissions. In the subtle legal form, it looks like an annual portfolio rebalancing that happens to involve selling and buying multiple positions, generating transaction costs that benefit the advisor's firm. It looks like recommending a move from one fund family to another when the new funds happen to carry a higher revenue sharing arrangement for the advisor's firm. It looks like recommending the purchase of a variable annuity with a surrender charge period that locks your money in for 7 to 10 years and pays the advisor a commission of 5 to 7% of the invested amount up front. Variable annuities are not inherently bad products, but they are the highest commission product in the retail financial services industry, and they are consistently recommended to retail investors at rates that far exceed any objective assessment of when they are the genuinely optimal solution for a client's specific situation. If your financial advisor has ever recommended a variable annuity, ask yourself one question before you signed. How much commission did this advisor receive on my purchase? The answer is publicly available in the product's prospectus, and it will tell you a great deal about whether the recommendation was in your interest or the advisor's. The third way advisors drain retirement accounts is through inappropriate risk positioning that serves the advisor's interest in retaining assets under management rather than the client's interest in optimizing after-tax retirement income. Many advisors have a financial incentive to keep clients fully invested in equity-heavy portfolios for as long as possible because advisory fees are typically calculated as a percentage of assets under management. Cash, treasury securities, municipal bonds held directly, and other low-cost alternatives generate little or no fee revenue for the advisor because they are not typically held through the advisor's managed account platform. A client who should rationally hold 20 to 30% of their retirement portfolio in low-cost bonds and treasury securities may be advised to hold a higher equity allocation than is genuinely appropriate for their risk profile and income needs because the advisor earns more from a fully invested equity portfolio than from an appropriately diversified portfolio that includes direct-held fixed income securities. This conflict of interest does not require the advisor to be dishonest. It simply requires the compensation structure to create an alignment problem between what earns the advisor the most money and what produces the best outcome for the client. The fourth way advisors drain retirement accounts is through the failure to integrate tax planning with investment management, which costs clients enormous amounts of money in avoidable taxes across the retirement distribution phase. A purely investment-focused advisor, which describes the majority of advisors in the retail financial services industry, manages the portfolio for pre-tax returns without modeling the tax consequences of each investment decision in the context of the client's overall income picture. The advisor who rebalances the portfolio by selling appreciated positions in the taxable brokerage account without considering the capital gains tax consequences of those sales, without considering the impact on provisional income and Social Security taxation, without considering whether the realized gains will push the client into an IR/MAA surcharge bracket, is costing the client money through tax inefficiency that never appears as a line item fee, but that is as real and as costly as any explicit charge. True comprehensive retirement planning integrates investment management, tax planning, Social Security optimization, Medicare premium management, estate planning, and withdrawal sequence optimization into a single coordinated strategy. The vast majority of commission-based or assets under management advisors provide investment management and call it financial planning. The difference between those two things for a middle-class retiree household with $500,000 across multiple account types is worth tens of thousands of dollars in after-tax lifetime income. The fifth way advisors drain retirement accounts is the one that is most difficult to see and most difficult to quantify, but that may be the most expensive of all over a full retirement lifetime. It is the advice not given. The Roth conversion strategy that was never modeled because the advisor does not specialize in tax planning. The Social Security claiming optimization that was never run because the advisor does not have access to Social Security analysis software. The Medicare IR/MAA management strategy that was never discussed because the advisor does not track the 2-year look-back implications of portfolio decisions. The estate planning review that was never initiated because the advisor does not coordinate with estate planning attorneys. The widow's tax penalty analysis that was never performed because the advisor does not model the surviving spouse scenario specifically. Every one of these omissions costs money. In some cases, it costs the client far more than all the explicit fees combined. The advice not given is invisible precisely because the client does not know they needed it. They do not know to ask for it. They do not know it exists. And the advisor who does not provide it faces no consequence because the client has no way to measure what they did not receive. So what do you do with this information? The first step is to determine what type of advisor you currently work with. There are 2 fundamental categories. A fiduciary advisor is legally required to act in your best interest at all times. A suitability standard advisor is legally required only to recommend products that are suitable for your general situation. To determine which type of advisor you have, ask them directly and in writing to confirm whether they are a fiduciary acting in your best interest on all advice and recommendations at all times. A genuine fiduciary will confirm this without hesitation. A non-fiduciary will either deflect or qualify their answer in ways that make their non-fiduciary status clear. The second step is to request a complete fee disclosure. Ask your advisor to provide a written statement of every dollar of compensation they receive in connection with your account, including advisory fees, fund expense ratios on funds they have recommended, any revenue sharing or 12b-1 fees their firm receives, and any commissions on insurance or annuity products they have sold you. Add those numbers up. Compare the total annual cost to the 0.3 to 0.5% total annual cost of a comparable portfolio managed by a fee-only fiduciary using low-cost index funds. The difference is your annual fee drag. Multiply it by 20 years and compound it at 5% to see the lifetime cost. The third step. If the analysis reveals that your current advisor is not a fiduciary and that your total annual fees exceed 1%, is to interview fee-only fiduciary advisors. Fee-only means the advisor is compensated exclusively by fees paid directly by you and receives no commissions, revenue sharing, or third-party compensation of any kind. Fiduciary means they are legally required to act in your best interest. The combination of fee-only and fiduciary is the gold standard of retail financial advice, and it is available at every income and asset level. The National Association of Personal Financial Advisors, which operates at napfa.org, maintains a directory of fee-only fiduciary advisors, searchable by location and specialty. A fee-only fiduciary who specializes in retirement income planning will cost you between $200 and $400 per hour for comprehensive planning work, or a flat annual fee of $1,500 to $4,000 for ongoing advisory services. Compare that to the $112,000 Sandra paid Rick over 11 years for advice that was legally required only to be suitable rather than optimal. Sandra, our HR director from Dallas, made a change 18 months ago. She interviewed 3 fee-only fiduciary advisors after watching a video that explained the fiduciary distinction clearly. She selected an advisor who charged a flat annual fee of $2,800 for comprehensive retirement income planning, including tax strategy, Social Security optimization, Medicare premium management, and estate planning coordination. In the first year of working with the new advisor, Sandra executed a precisely calibrated Roth conversion that stayed below the IRMAA threshold, reduced her traditional IRA balance, and modeled correctly for North Carolina state income tax treatment. She filed a Social Security claiming analysis that revealed she should delay claiming for 2 additional years to maximize her lifetime benefit and Carl's survivor benefit. She restructured the brokerage account to improve asset location and reduce the annual tax drag on dividends and capital gains. And she replaced the variable annuity that Rick had sold her 6 years earlier with a direct treasury ladder that eliminated the surrender charge risk and produced a comparable income stream at a fraction of the cost. The total fee savings in year 1 of working with the fee-only fiduciary versus continuing with Rick was approximately $8,400. The tax savings from the coordinated strategy added another estimated $12,000 in reduced tax liability for the year. Sandra paid $2,800 for the advice that produced those savings. The net benefit of making the change in year 1 was approximately $17,600. Multiplied across the remaining years of her retirement, the decision to find a genuine fiduciary advisor is one of the highest return financial decisions Sandra has ever made. Go to the comment section right now and tell me whether you currently work with a financial advisor and whether you know for certain that they are a fiduciary. Tell me what you pay annually in total advisory fees and fund expense ratios combined, or if you do not know, tell me that you do not know, because that uncertainty is itself important information. Tell me whether your advisor has ever run a Roth conversion analysis, a Social Security claiming optimization, or a Medicare IRMAA management plan specifically for your household. Drop your situation in the comments and we identify the gaps together. Like this video if the fee opacity calculation changed the way you think about what your advisor relationship is actually costing you over a retirement lifetime. Subscribe to Retire Right America and hit the notification bell so every financial survival guide we produce reaches you before another year of avoidable fees and missed planning opportunities compounds against your retirement wealth. Share this with someone who has a financial advisor and has never asked them whether they are a fiduciary, because the question takes 30 seconds to ask, and the answer could be worth hundreds of thousands of dollars over the course of a retirement. This is Retire Right America. Stay informed, stay protected, and make sure the person managing your retirement is legally required to put your interests first.